Most dividend investors just look at a stock's current dividend yield and say that, hey, 2% yield, that's not very much.
Not impressed.
Why don't I instead go for this 10% yielding stock? In this video, I'm going to show you the real power of dividend growth investing. It has nothing to do with today's dividend yield. At the end of the video, I'll show you 3 examples of Warren Buffett's holdings that are producing a 31.6% income yield for him right now.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Let's say you're looking into a stock that is currently trading for $100 per share. The dividend right now is just $2. So if you want to calculate the dividend yield, we can simply take 2 divided by 100, and it gets us a 2% dividend yield. However, we have not yet considered what the future dividend growth of this company is going to be. Let's say this company has a very high probability of continuing to grow its dividend at a rate of 7% per year. If this company is able to grow its dividend at 7% per year, here's what's going to happen. The dividend at $2 is going to grow each and every year, and at year 5, it will be paying $2.62, year 10, $3.68, year 15, $5.16, and so on. After 30 years of 7% dividend growth, the yield on your original $100 investment will then be 14.2% per year. The dividend in 1 year alone will be covering 14% of your original purchase price. And this assumes absolutely no price growth. The same share you owned in year number 1 is still worth $100 in year number 30. However, this is probably not very likely. If other investors were to see a 14.2% dividend yield, they would probably flock to buy the shares, particularly if they were in a quality company. So let's say that the price drops by 50% relative to the dividend, and the yield goes from 2% up to 4%. So in this case, the year 1 dividend was still $2. We still see the same 7% dividend growth over time. However, the price is different. So the 5-year price after the 50% drop is only $65.54. So you've actually lost money after 5 years. 10 years, we keep this relationship the same. So $3.68 dividend divided by $391.92 price equals 4%. So now the price is growing exactly with the dividend. And after 30 years, we see that the yield on cost is still 14 divided by what you paid, $100. However, the current dividend yield in the market is only 4%. So that means that the rising dividend has led to a rise in the price of the shares. So after 30 years, not only have you collected all of these dividends growing over time, but you also have a stock worth $355.71. In the next one, let's assume that we don't get this 50% price drop, and let's just assume that the yield stays constant through time. So a 7% increase in the dividend leads to a 7% increase in price, keeping the yield at 2% forever. So after 30 years, you still get the same $14.23 dividend in that year. The price to keep the yield at 2% would have to go up to $711.43. So in this example, your dividend went up 7 times, roughly. Your price also went up 7 times, and your yield on cost after 30 years would be 14.2%. Now you may think, wait a minute, how is it possible for a stock to actually do that? To illustrate, let's bring in a couple of Warren Buffett's purchases going back to as early as the 1980s, and we'll see how this concept has worked for him. At number 3, we've got American Express. Buffett bought it back in 1993, paying an estimated cost of $8.49 per share. Well, today, American Express is paying $1.71 per year in dividends. The stock price is currently $177. When Buffett started buying American Express, the shares were paying out about 17 cents per year. The dividend yield at the time was 3.9% on a price of $4.20. The dividend today is $1.71, and the stock price is $177. So if we calculate how much Buffett is making per year based on what he paid, we can come up with a $1.71 dividend divided by an $8.49 purchase price, and Buffett's yield on cost on this particular investment is 20.1%. So Buffett is getting 20% of his original investment back every single year. Not only that, but his stock has gone from $8.49 up to $177. Moody's is even more impressive. Buffett bought it back in 2000 at a cost of $10.05 per share. At the time Buffett started buying it, the payout was 30 cents per share, and the yield was around 3.7%. The dividend today is $2.41. So if we take $2.41 divided by Buffett's purchase price of $10.05 on average, the current yield on cost of this position is 24%. And again, we see that the stock price has gone up from $10 to $370. But that's nothing compared to Buffett's most impressive pick, Coca-Cola. He bought Coke back in 1988 at a cost basis of $3.25 per share. And today the payout went from 3 cents back in 1988, or around 3% dividend yield, to a dividend of $1.65 today on a stock price of $55.69. So if you calculate the current dividend of $1.65 divided by what Buffett paid, $3.25, we can calculate Buffett's yield on cost is over 50%. In other words, Coca-Cola is paying Buffett half of what he paid originally every single year. And that dividend income continues to grow over time. So 50 years from now, who knows what this dividend per share will be, but we can know pretty confidently that Buffett will still be holding on to his shares. Speaking of Warren Buffett, if you want to know what I think is his favorite investing ratio to look at when identifying companies that can do this kind of dividend growth over time, check out this video right here.